We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Keith Weiner. Keith is the president of the Gold Standard Institute USA, the CEO of Monetary Metals, and also holds a PhD in economics. Thanks for joining me today, Keith.
Hey, Tom. Good to be back.
Always excellent to have you. You know, it's always a pleasure to speak with you. I've told some people that talking to you is like speaking with Einstein if he was interested in economics and gold. So it's always a challenge for me to keep up with you.
Well, thank you.
So, Keith, some of your research was recently featured in the 2022 In Gold We Trust report that our friend Ronnie Stofferle puts together. So your contribution to this year's report was based around the supply and demand dynamics of the gold market. So why is gold different than ordinary commodities in the way that the market works for it? Maybe starting with having a glut of gold. Of course, everybody, I'm sure by now, has heard about the story of Uganda, where they supposedly found 32,000 tons of gold. So maybe let's start there.
No, they claimed 32 million, didn't they? It was some wild number greater than not only all the gold believed to have been mined in human history, but something way beyond that.
I think it depends on which version of the article that you read, but either way.
Yeah, and you know, of course, all the anti-gold people are circulating that because they think that's going to collapse the price of gold. Kind of sort of failing basic economics 101. Like no one's going to mine it when, you know, driving the price down below their own cost of production. Mm-hmm. And when you look at mining projects, and we look at a lot of them, I mean, you know, a really, really, really good one, the cost of mining is $500-$600 an ounce. So this is nothing that's going to drive, even if it were true. And of course, somebody claiming to have a gold reserve that big is just absurd. But taking a step back, and I think the question you're asking, what's different about gold? Virtually all of the gold ever mined in at least 5,000 years of human history. A friend of mine wrote a book called The Dawn of Gold, in which he did some, not sure if I'd call it research, but discussion with anthropologists. And he came to the belief that the Neanderthals were picking gold nuggets out of the stream beds in Europe 13,000 years ago. But for at least 5,000 years, we've been mining gold, and virtually all of that gold is still in somebody's hands. Mm-hmm. The gold doesn't go away. It's not consumed. The consumption applications, you think about gold teeth, you think about jewelry, all of that stuff is recycled eventually. Now, sometimes people are buried with gold teeth, but they don't like to think about grave robbers, but that's always been a thing. The gold doesn't really go away. I think sometimes ships sink to the bottom of the ocean. You know, there are salvage divers that find these things. So all of the commodities are produced to be consumed, and we don't really keep very large inventory buffers. And if we get an inventory buffer, you know, let's say the wheat harvest is 1% greater than what the Department of Agriculture estimated it would be, then the wheat price, you know, collapses, and it's called a glut. And it's a disincentive for farmers to grow any more wheat for a while. And it's an incentive for the marginal user of either grains or starches to switch from whatever they normally use to wheat because wheat is suddenly cheaper. But there's no such thing as a glut in gold. We've been accumulating it for 5,000 years, which is an astonishing fact in itself. And there's a lot of inferences you can draw from that. You know, and that's no impediment to mining more. There's gold mining as a robust trade today. There's gold mining occurring all over the world, and we're adding to that incredible stocks of gold, and that's what makes gold different.
Mm-hmm. So, Keith, maybe contrast for us, you know, those two markets with the current example of the oil market. We're seeing it in backwardation, and that's fairly typical of that market, correct?
Yeah, I mean, a commodity like that can swing back and forth between the normal condition. So Keynes got it backwards. He called it normal backwardation. Like almost everything else in his economics, he's either exactly wrong or not even wrong. But normally is as contango. So to buy a commodity for future delivery, you pay a premium to the spot price. And why is that? Well, there's a cost of storage and a cost of finance. if you want to buy something for January delivery, and here we are in July, then someone's going to have to buy it and warehouse it for you, and then deliver it later. And so there's a carry cost and interest rate involved in that, and that's normal. So that's called contango. The futures price is higher than spot price. Oil is the opposite at the moment, and that means the futures price is lower. Now, all the time you see on Twitter people saying that, oh, look at the forward curve in oil as they plot out all the future prices, and it's saying that oil is going to be expensive until 2024, something like that. No, those points out in time are not any kind of prediction as to what the price is going to be. That's the price you pay today to sign up for a contract, and there are arbitrages that pull all the future prices to some spread to the current spot price. So what backwardation means is that if you had that commodity, let's say you had crude oil in a tank and you could deliver it, you could deliver that crude oil and simultaneously buy a futures contract and make a profit to do so. Now that's considered to be risk-free because you sold the commodity for cash. You're buying the futures contract without margin, without any leverage. So you sell the spot commodity for, well, today the prices drop, but let's say, to make the math easy, you sell the spot commodity for $100 a barrel, and you buy a future a couple of years out for $90 a barrel. You actually have a $10 profit you can take out, and you still have enough cash in your account to fund your purchase. That's considered to be risk-free. And so if there's $10 risk-free, why is nobody taking it? It sits there on your screen. This isn't a millisecond opportunity that's gone to the high-frequency traders. This is sitting there on your screen day after day, week after week, month after month. No one is taking the risk-free profit. Why? Well, in the case of crude oil, obviously, they haven't got any crude. Mm-hmm. The only way to participate in this trade is you have to actually have the commodity to be able to sell it. Whereas in contango, the way to make money is to borrow dollars, buy the commodity, and sell it forward. And there's all kinds of risks there, and all you need is access to credit. But in a backwardation condition, all you need is the actual commodity, and backwardation is a sign that you have a scarcity. So right now there's a scarcity of crude, unsurprising given what's happened to geopolitically. Without getting into all that, it's unsurprising that there's a shortage of that right now. Mm-hmm. And so there's a backwardation. That backwardation has been going on for many months. It's quite persistent at the moment.
So Keith, explain the idea of marginal utility and how this applies to gold.
Yeah, so this gets into one of those inferences that I mentioned with gold. So as we were just discussing before you hit the record button, I live in a really hot, really dry desert here in Phoenix, Arizona. And yesterday, just before sunset, it was 110 degrees Fahrenheit, which I just looked up, although it's 43.3 degrees centigrade, and like 5% humidity. Mm-hmm. That's in the shade. So if you were walking around in the sun in the afternoon at peak temperature, it was probably well over 45. 5% humidity, the sun's blazing, that's in the shade. The sun blazing on your head is probably the equivalent of 55 or 60 degrees centigrade. It's hot enough to make tea here and cook eggs and things like that. Very quickly you'd be thirsting to death. So if you were wandering around in the desert, the need for water would be dire. So imagine you come across a guy with a pickup truck, and out of the back of his pickup truck, he's selling bottles of water. What are you willing to pay for the first bottle of water? As I say in my articles, you'd be willing to empty your wallet, you'd be willing to empty your bank account. Because if you don't buy that water, you're dead. Mm-hmm. And every year a couple hikers die out in this heat. What would you be willing to pay for the second bottle of water? Well, that's a different equation, isn't it? Mm-hmm. So that's your spare to get you back to civilization. So it's definitely worth something, but it's not worth everything. What would you be willing to pay for the third bottle? Well, that's a spare to the spare. What would you be willing to pay for the fourth bottle? Somewhere by bottle 4 or bottle 5, it's actually a burden. You actually don't want it. It's worth 0 or less than 0. So marginal utility is the concept of what is the value at the margin. So 2 bottles is worth more than 1, but the second bottle is worth less than the first bottle. and the third is worth less than the second. And so marginal utility in every ordinary commodity is declining. That's why you have the concept of glut. If the wheat harvest, comes in 1% greater, the value of that extra wheat is far lower than the value of the prior units of wheat, and price is set at the margin. Now, gold, as we said a moment ago, we've been accumulating it for 5,000 years without any particular limit. And what does that mean? That means that the marginal utility of gold either isn't falling, or if it is falling, it's falling so slowly that after 5,000 years, the marginal value, the value of the next unit, the nth plus 1 ounce of gold, hasn't fallen below the cost of production yet, which there's no other commodity that's remotely close to that except silver, the other monetary metal. And so it's, in my theory, you can basically say that gold's marginal utility doesn't decline, which is a fascinating thing that leads to its monetary properties, including accumulation, including it's really good as a unit of account. If you keep your books in gold and you have a gain in gold ounces across the year, then your business created value. If you keep your books in dollars and they screw with the dollar, which is their stated purpose, is to debase the dollar at a rate of 2%, how do you know over long periods of time whether your business actually created wealth or whether the unit in which you measure maybe perhaps a decline in wealth, the unit is shrinking faster than your wealth, so it appears it's like a mirage or an optical illusion. Your business appears to have, created something or made money. So that's a unique property to gold.
Yeah, of course, your measuring stick is declining along with your fiat dollars, let's say.
Yeah, so imagine you're an engineer trying to design and build a tall building. Imagine if you had this meter stick that at ground level, the meter stick is, I'll make my hand, it's not quite, it's like half a meter to fit the frame of the video. But then as you go up each floor, the meter stick is shrinking. And by the 50th floor, the meter stick is this big. And so then the engineering profession would have height adjusted meters. And that's a 50th floor adjusted meter. And you can't compare that to the 40th floor meter without some adjustment factor. I mean, nobody would be able to build a building that would stand. It would be like some bizarro world where, reality wasn't consistent and, like some sort of bad trip on some sort of bad hallucinogenic drug. That's what we live with in the world of money by attempting to use the dollar. And gold, just keeps that straight.
So how does that, let's say, compare to Bitcoin? There's only ever going to be 21 million Bitcoins mined, minus all the losses of people that have thrown out old hard drives or whatever it is. Does that, in some ways, make the argument for Bitcoin better than that for gold because there aren't going to be more Bitcoins mined? Well,
I was going to say that in light of the diminishing marginal utility argument, that gold has a non-diminishing marginal utility and everything else has a diminishing or potentially rapidly diminishing marginal utility, the designer of Bitcoin was so afraid of that question that he said, we will not allow the quantity of Bitcoin to grow beyond 21 million. So he's quite confident in how he designed, or dare I say, centrally planned Bitcoin as a monetary system, never to dare test whether its marginal utility is falling or not, or he maybe thought that he knew the answer, which is a little bit hubristic, but that he believed that Bitcoin's marginal utility does decline, so therefore there has to be a strict cap on it. But there's something very counterintuitive to this idea. People think that value comes from scarcity, and most people intuitively feel the value of a currency is 1 over n, where n is the number of currency units. And so they think of the idea of dilution. Well, Bitcoin will have no more dilution, as if adding a unit decreases the value of all the other units proportionally or something like that. But look at the US dollar. I used to say this, now the US dollar has really gone up in value in terms of all the other fiat currencies quite a lot. If you haven't looked at the dollar index chart recently, everybody should take a look at that. It's astonishing what has happened and how fast. But even before that, I would say, the dollar is quite a valuable currency. And yet, if you look at quantity, the quantity of dollars that are out there are far, 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 far higher than any other currency. It's not even close. So if one thought that the value of a currency unit was 1 over n, the dollar should have the least value because it's been printed, if one wants to use that term, to much greater quantity than anything else. And so I don't think one can understand money as a scarcity equation with some sort of 1 over n type function. The fact that Bitcoin designers designed it, or designer designed it that way, either Bitcoin does have diminishing marginal utility, which would be an open and shut proof, case proving that it's not money, if that were true, or they erred very seriously, and then the whole Bitcoin system is quite flawed. Mm-hmm. But either way, if it's money, it shouldn't have that failing. People should be happy to accumulate it. And so, unlike the bottle of water, the thing with gold, which is true for individuals and it's true for an economy, nobody refuses the nth plus 1 ounce of gold, ever. And it doesn't matter how many ounces of gold you have, the nth plus 1 is still appreciated. And that's what you'd expect for money. No one turns down payment of money. Mm-hmm. Now, they might invest it, they might spend it, they might gift it to their grandkids, whatever it is, but money is valued regardless of how much of it you already have.
Mm-hmm. And Keith, you kind of touched on the idea of volatility in there as well. So, you and I were speaking before we hit record here about the volatility, let's say in the art market versus Bitcoin versus gold. Explain to us a little bit about, the volatility of each of those really plays to the strengths of gold as, quote unquote money.
I was going to say, so everybody thinks gold is boring, gold is stupid to own, gold isn't going to go up to the moon. Well, the latter is certainly true. And if you think about it, money should be boring. If money is giving you the excitement of a roller coaster and a skydive and a rocket ship, perhaps that's not actually a good thing for money. Mm-hmm. So we were talking about the art market, and I'd mentioned that I'd read a story of a guy that bought some famous painting in fall of 2007, paid $11 or $13 million for it. And fall of 2008 sold it for $100,000. So, better than a 90% loss on it. And it isn't necessarily the volatility to say, well, the value of the painting fell. Rather, there's a bid and an offer price. And when he bought it, he paid the offer price. And when he needed to sell it with urgency, clearly sold it for the bid price. And what happens is in all the markets for so-called, tangible or hard assets, real estate, antique cars, whiskeys, artwork, whatever, the bid-ask spread is pretty wide to begin with in a normal market. And then in times of stress, then the spread really widens and you find there's almost no bid at any price. And, he found a bid, 90% down from where he paid a year earlier. So it isn't necessarily volatility as such. I think that happened also, but it's simply the bid-ask spread widening to be, 90%, wide. Bitcoin certainly is volatility. I don't think the spread widens anything near like what happened with that artwork. But if there's a change in demand, then since quantity doesn't change, the only factor left to absorb the change in demand is price. And so on the one hand, the Bitcoiners are cheering it. It's actually kind of perverse. They cheer every time somebody loses a hard drive or forgets their password or whatever. It's like the money is so good that you have to cheer the destruction of it. There's something that's kind of not entirely benevolent about that sentiment. But, anyway, the quantity is what it is other than those two losses. And if there's a change in demand, the smaller the float, I mean, think of the same thing in shares. There's a float, which is the shares that are actually trading versus, the family that founded the company, a couple of big funds that aren't, planning to sell. The smaller the float, the more the volatility is with, slight changes in the news or the sentiment or the credit cycle or whatever. And Bitcoin certainly has proven that to be in spades, as the thing can skyrocket in phase one, and then the thing can crash, in phase two. And that's a feature, not a bug. It was designed not to have any other mechanism other than price absorb or change in response to, subtle variation in demand. So you get this behavior And of course, they're all cheering for demand to go up, and therefore the price of Bitcoin is going to be $1 million a unit, or Michael Saylor says it'll go up forever, whatever these prognostications may be. But that precludes it for use as money. I mean, think about using it as a unit of account, and that the dollar is slightly misleading. You have a business for 30 years, the business went from $1 million valuation to a $10 million valuation. Is that 10x increase due to dollar debasement, or is it because you were a savvy businessman? Very hard to tell. You try to adjust it with 2022 dollars versus 1990 whatever. Now imagine a Bitcoin. You had a business in 2010 that was worth 5 million Bitcoin, and today it's worth 50 Bitcoin or something like that. Is that because your business had a hyper collapse? You utterly wiped out and ruined, and you have one last pen that still has value, you can liquidate at auction and give something back to the creditors? Or is it because the unit changed in value so much that as an artifact of the change in value of the unit, the business appears to have completely collapsed, but actually the business is doing just fine, and that you're using the wrong rubber band as a meter stick?
Mm-hmm. Yeah, it's a great way to put it, the wrong rubber band. So, Keith, how does all of this compare in the silver market? We've discussed a lot of the dynamics of the gold market, but because of the massive industrial demand portion of the silver market, does it behave more so like a regular commodity than a monetary commodity?
So, I've always argued silver, yes, it has an industrial component, and that gives it some more volatility to its price. I've always argued that silver is still a monetary metal. I was on a panel at the IPMI conference a couple of years ago. I guess this was before COVID. And there was a guy from Metals Focus who was my co-panelist, and he had all the data looking at, what's the correlation of the gold price to the copper price, to oil, to wheat, to gold. And yes, it turns out that it has a far better correlation to gold than any other ordinary commodity. What I think makes it somewhat different is the use case. A lot of people just kind of assume, let me take a step back. You've got to ask, why are there two monetary metals? Everything in human society that creates a network effect tends to be one winner take all. There's one internet protocol, there's one, web protocol, there's a lot of things. The width of the lane of road that we have goes all the way back to Roman, essentially mil-spec, that, a chariot had to be wide enough for 2 horses. And then, so that was the width of the wheels, and that created ruts in the roads. And then every horse cart ever made since then had that width, because you didn't want to, if you didn't fit the ruts in the road, you'd break your axle, right? And all the way to the modern day, there were companies that had that, the templates to make that size. So why are there two? And people, to the extent they think about that, they say, well, silver is for small change, gold is for big transactions, which is certainly true. But I think there's something deeper, and that is gold is great at carrying value over distances. If you think about a merchant going from here to there, and you need to carry a large amount of value, gold is very light. I mean, you can put a small amount of gold in your pocket, which is a very large amount of value. Silver isn't so good for that, but silver is good for the wage earner to carry value over time. So think about the problem of you're skilled craftsman of some sort, or skilled worker of some sort, and you're setting aside 10% of your wage. So today, maybe you make $1,000 a week, something like that, and you want to set aside 10% of that. So after taxes, that would be, well, the tax man's going to take a lot, but that would be $60, something like that. Well, if you're doing that in silver, that's 3 ounces of silver. So it's a tangible amount in your hand, it has a heft to it. And that's a very reasonable size unit of silver to buy as an ounce. If you're doing that in gold, $60 worth of gold is a gram, which is not that reasonable a size. And certainly historically, the precision machining and manufacturing to be able to get something of that size would have made it very expensive. And so for the wage earner, the cost to get in and out of silver in the kind of sizes that he was looking to do was much lower than gold. So gold is the most marketable good for reasonably large amounts of value, marketable meaning that measure of that bid-ask spread. And silver is the most marketable in the small, which is really what matters to wage earners that are saving. And then in their retirement, they're dishoarding their silver. They're selling the silver to buy groceries. And again, getting the best deal in silver. So silver is, and to this day, more of a wage earner's metal, and gold being a capital asset for the capital owning class. And so they tend to trade differently because the problems of the capital class are not always in sync with the problems of the working class.
Mm-hmm. So does that make, in some ways, we've heard about let's say the energy stored up in silver, as in the analogy of the beach ball being held underwater. Does that make for a potentially volatile move back to the other side for silver?
You're talking about the gold silver ratio? Mm-hmm. Yeah, I mean, I think if you were looking to put some money into into the monetary metals right now, at this gold silver ratio, and assuming you weren't using leverage and you had a while to wait, silver seems to be the better bet. I mean, by any historical measure, by the measure of our gold basis, silver basis analysis, by any measure you look at, yeah, silver is more likely to go up in gold terms than the other way around over the intermediate to long term. Mm-hmm.
So Keith, of course, we're kind of in this position right now of seeing both of the monetary metals kind of the price come off a bit. And this is, of course, very associated with the rise in interest rates. You recently wrote an article discussing the idea of interest rate hikes fixing inflation. So is it possible that along with the artificially controlled price of money, that we're also not in a free market?
Yeah, there's totally no such thing as a free market in money. By degrees, even at the founding of America, they fixed the price of silver in terms of gold. And they got it slightly wrong relative to the market. And so silver being slightly overvalued as a monetary unit versus its global market value, silver came to, this is Gresham's law, you fix two things. The overvalued one comes to market, and the undervalued one disappears into ports or gets sold elsewhere for higher price in global markets. So the U.S. was de facto a silver standard from the Coinage Act of 1790. Then they reversed it in 1834, effectively a gold standard. Meanwhile, we had the Bank of the United States, the first crony central bank. We had the Second Bank of the United States. We had the suspension of specie during the Civil War. We had what was called the crime of 73, when they demonetized silver in the Coinage Act after the Civil War in 1873. We had a variety of monetary intrusions, the so-called free banking era, where these banks, in order to get a charter, in order to get government permission to be allowed to operate, let that sink in for so-called free market, they had to load up on state government bonds. And the states in those days would default, fairly frequently. And so any bank that was forced to load up on state government bonds and then the state defaulted, the bank went bust. And then, of course, capitalism, free markets were blamed. The banks were unregulated. You see, that's why they all failed, as they were unsound. No, they were forced to buy crappy bonds by the state governments in order to get a license. So we created the Fed in 1913. Obviously, people know the rest of the history from there. No, there's no such thing as a free market in money. And all the gyrations that we see are the effects of that. Most people think in terms of monetary debasement, inflation, rising prices, rising quantity of dollars. But I think it's more interesting and more important to look at the falling interest rate as a driver of a lot of this. And now that the Fed thought, maybe it still thinks, we'll see, that they can hike rates, causing all sorts of, or I should say precipitating. The cause of it is the destruction of the boom, and then they precipitate a bust when they attempt to hike rates. That's what happened in 2008, and that's what's happening right now. And so when the bust is happening, everybody who's over leveraged has to sell assets in order to raise the cash to repay debt that isn't going to get renewed. They can't roll some of their debts. So you get this deleveraging, and of course the deleveraging is forcing margin calls on other participants. And so it's a positive feedback loop that can run for a long period of time if the Fed doesn't reverse what they're doing. And so, yeah, you're seeing the sell-off in everything, but far less in the monetary metals than everything else, once again.
So this is really, in some ways, you could call it a very removed attempt at actually controlling inflation by destroying the demand side of the equation, right?
There's the funny thing about that. People buy into, like, I've read about the politics of building an expensive light rail system. A lot of cities, promoted this for decades. We have to have a light rail system. And the average voter is looking at this saying, I ain't gonna use that thing. But they're stuck in traffic, frustrated with why it takes an hour to get home from work. And they're thinking, all these other bozos will be out of my way because they'll be riding that thing. And so I'll vote for it even though I don't plan to use it. And meanwhile, all the other people in all the other cars are thinking the same thing. Mm-hmm. And so everybody votes for something that none of them want to use, thinking that everyone else will use it. Well, this idea of let's hike interest rates to lower prices is basically let's have everyone else laid off so their demand will be forcibly reduced. And now that they're not outcompeting outcompeting me to bid products up, I can buy all the stuff that I want at lower prices. It's kind of there's something not benevolent about that political dynamic. I'll just leave it at that. But by what they're doing, by attacking the employment, is ultimately attacking production and producers. It's this idea that if we attack the producers enough, then somehow demand will go down. But what you're attacking is supply, and demand maybe is affected as a follow-on or a second-order consequence of attacking supply. So every business is using credit to finance itself. You're hiking the cost of credit, which is first of all going to destroy the marginal producer in every market. So everything that people buy, there will be less supply of because the marginal producers will all be wiped out. And then for those who remain, you're hiking their cost and essentially widening their profit. For the survivors, the profit margins are getting wider. That is precisely the opposite of lowering prices. I mean, if here's how I like to put this. There are many, 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 many ill effects of a falling interest rate. It's horribly destructive in lots and lots of ways. However, if one were to ignore all of that and focus only on one variable, which is consumer prices, and one wanted lower consumer prices, then one should want falling interest rates, not hiking interest rates. Mm-hmm. So we released a cartoon showing Fed Chairman Jay Powell with a gasoline truck and a nozzle spraying gasoline on fire, and the fire is labeled inflation. And there's a reporter saying, do you think that'll be enough to put out the flames? Like, it's not even wrong. You got it backwards. Mm-hmm. If you wanted lower prices, you should be pushing interest rates down, which is why we've had the great disinflationary environment of 1981 through, let's say, through COVID. Mm-hmm. Was the falling interest rate environment made prices pretty soft. Now you're hiking interest rates. Well, I don't think he's going to be able to get away with hiking interest rates very, very much longer or very much farther anyway, for a lot of other reasons. But the effect on prices would be rising prices. Mm-hmm.
How do we keep getting monetary theory exactly wrong? Is this kind of an artifact of what you had said earlier in the interview, that Keynes had got a lot of his theories exactly wrong, and this is just a follow-on effect of all of his, in some ways, all of his disciples?
Yeah, I think that. So, the end of the 19th century and in the early 20th century, I guess we call that the progressive era, where they took that word progressive and nobody contested it. So that's now called, but it's a very regressive philosophy, which is socialism, right? So socialism, I talk a lot about the court economists and the dirigistes. There are very few people that are actually interested in economics anymore. They're either interested in central planning, they want to be the technocrats that fine-tune the economy, or they want to be the propagandists that sell it. the Paul Krugmans with their New York Times columns, selling this rubbish. And so when the progressive era, came in and that sort of politician took over, it took over because there was a wave of different thinking and people with different ideas versus the classical era. And the socialist way of thinking is not an honest way of thinking. They're looking at how they can get one over on you, how they can get something for free, get something for nothing. And it should be obvious that in order for Paul to get something for nothing, then Peter has to get nothing for something. That should be obvious. But if you make an economy big and complicated enough, introduce a lot of variables and distort everybody's use of concepts, words like money and so on, you can get everything, so big and cloudy that you can have a monetary system and a monetary theory that promises something for nothing. Mm-hmm. And so I read a lot about this, that I think it's terribly convenient for the central planners that people's only understanding of monetary debasement is rising consumer prices. And the consumer prices aren't rising, therefore it's all good and there's not a problem. And so that essentially gives them carte blanche as long as consumer prices aren't rising too much anyway. And so I think it serves the ends of the socialists that are, essentially consuming the capital that we inherit as our legacy. Like all socialist utopias, things are going relatively fine until you run out of the seed corn. And when that's all eaten up, then the real misery sets in. And then everybody hates whatever leader happens to be in power. That happens. I think it's terribly convenient for them that everybody thinks in these terms: quantity theory of money, the definition of money being credit issued by the government. I mean, what a perverse idea that is. And think about what interest is served by defining money that way. But, and not to gripe too much about it because everybody accepts that, but I've been in amongst academic Austrian economics professors that will insist that's the right definition and gold is not money today, they'll tell me. But anyways, all of these things reinforce the socialist trend. And so, there's a lot of government spending, right? If you're an economist today, especially in the monetary area, and you want a government grant, and as an academic, you need grants, and most of the grants are government grants. It's easy to get a Fed grant as long as you're saying things the Fed likes. If you're saying, gold is money, the rest is credit, and it's an unsound credit, it's counterfeit credit, you start saying the things that I say, I don't even get invited to the cool kids parties in Washington, D.C., let alone would I ever get a grant. Mm-hmm. Fortunately, I'm not looking for a grant, so it's all good, and I have no loss here. But, the order is seeking to reinforce the ideas that it wants to promote. And, there certainly isn't censorship. Nobody's ever threatened me to stop saying what I say, but they would just as soon ignore me and hope I go away than, give me any kind of platform.
Mm-hmm. Well, I appreciate you sharing your ideas with us here, Keith. It's always good to be able to evaluate these ideas and theories for their merits and see what the data actually bores out once we evaluate them, right?
That's right. People should always be looking to reality and say the purpose of a theory is to explain what you observe in reality. So I say, okay, virtually all the gold ever mined in human history is still in human hands. Mm-hmm. You can validate that. There's a million and one ways to look at, is that really true? And if it is true, think about what kind of theory would it take to explain it? And does quantity theory of money explain it? Does quantity theory of money predict that wouldn't be possible and would never happen? And if your theory predicts that something that did happen would never happen, you need a new theory. And the problem is it's very daunting, right, to go back and question and reject everything you've been taught since the time you were 2. I mean, what's the definition of money? Well, if you go on Google Images and do a search for money, you get endless page after page after page of paper with green ink on it. That's money. So now if you say that's not money, that's really daunting to go back and say, well, wow, everything I thought I knew about money is wrong.
Mhm.
So most people aren't willing to do that. It's much easier to go with the flow. Well, that's radical. That's crazy. Look at that guy. His hair is funny. They say that about me on Twitter all the time. But not engage in the idea, right? It's okay. If that's true, you have to explain it. And if your theory denies it, okay, how do you explain it? And so I put out a theory that explains it. And if there's any other theory that explains it, then that would be a very interesting debate. So far, haven't really encountered that.
Yeah, a character attack instead of actually arguing the point really weakens the argument from the other side.
That's right. But I would love to see if there were multiple competing theories, that is, that begin with the observed facts, but had an alternative way of. So, for instance, in physics, all the light that we can observe here on Earth coming from distant things is all redshifted. We know it's redshifted because every element has a characteristic spectrum. You can recognize hydrogen instantly, and if hydrogen is redshifted, then you know that it's hydrogen, and it's redshifted. You know how much it's redshifted. Mm-hmm. So that's the observed fact. The explanation, the theory, is that that's because everything is flying away from us at tremendous speeds. That the whole universe is still in the remnants of some cosmic Big Bang or explosion, right? Well, there's an alternate theory that says, the reason why is that as photons travel great distance, there's some sort of cosmic friction and they lose. This is an idea that I certainly wouldn't put it forth, but it's something I think about every once in a while in my copious spare time. And that is, if the photon is losing energy as it travels over great distances, E equals HF, H is a constant, F is frequency. As there's a decline in frequency, you'd get a redshift by essentially some sort of frictional force. That would be another theory that competes to explain the same phenomenon. And then whenever you have two theories that are competing, then you look for the corner case. You look for something. This theory predicts this. This theory predicts this. This was my answer to the gold and silver manipulation theory. Is I proposed the thought experiment. Two theories predict opposite things. Let's find that case. Let's get the data for that case and then resolve which theory is right, which theory is wrong. That's just how science is a process. Mm-hmm. Right? It came out with the whole mask mandates that science is a politicized conclusion. Follow the science, damn it. They tell you to, not drive your car and burn gas, or that you have to wear a mask now or whatever. And that's, science is a process of explaining reality. And if your explanation then contradicts reality, your explanation's got to go because reality ain't going. You would think that should be like table stakes, right? Mm-hmm. So that's what I encourage everybody to look at reality. Don't take my word for it. Look at, is it true that virtually all the gold mined in human history is still there? And if that's true, what does that mean? A lot of really interesting inferences you can form from that. And if those inferences aren't true, then what is? And how, think about it. Mm-hmm. And I think this all leads towards a proper monetary science that I think needs to be developed. And one of those days, I plan to write a book about that.
Excellent. Well, I hope we get to read that before too long, Keith.
I will try. Building a business at the moment, but it's definitely on my bucket list.
Well, maybe you can do it, as you said, in some of your copious spare time.
Oh, yeah.
Well, Keith, I think that was a great conversation. We touched on gold, silver, physics, and economics. So I think that's a good place to wrap up today's conversation. Of course, all of your articles and research, you guys also have a podcast where you do some interviews as well. All of that's available at monetary-metals.com and at The Real Keith Weiner on Twitter, right?
That's it.
Excellent. Thanks so much for your time today, Keith. Really appreciate it.
All right. Thanks for having me, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.